Ladies and gentlemen, on gold as an investment, or holding gold. This is from the American Institute for Economic Research special report published in 2005, so it's not particularly out of date. And the paper is yellowed so that I thought it must be 20 or 30 years old. This came folded up inside of a copy of Gold and Liberty by Richard Salzman, which I got at Strand Bookstore in Manhattan for $1 out in the discard racks. They do not know what they lose to me. So, some people think that gold's a great investment, and it is. And the reasons why it's a great investment and the reasons why it's actually not a very good investment are what we're about to go over here. First of all, if you think that gold's just another commodity, consider this statement. Quote, "The origins of all currencies or coins, fixed weight and fineness. Today, all are fiat currencies." Fiat means just by say so, just doing it. We say it. Because there is a limited amount of gold in the world, and paper money can be created without limit, gold is the ultimate protection against the debasement of currencies. End quote. That's why they've taken gold out of all the systems. Now I'm going to do some videos after this from this book, Gold and Liberty. And one of the points made in there is why Germany and Japan were able to get back on their feet after World War II. Interesting facts that. Let me skip a little bit. The current experiment with fiat currency has continued for many decades. Paper is paper, gold is money. As a financial asset, gold is unique because it is no one else's liability. This is the situation with anything tangible that one might own, but unlike, say, antiques, fine art, jewelry, or collectibles, the spread between bid and ask prices for gold is very narrow. Pause for a second there. Just last week, the Wall Street Journal announced the world's largest gold coin, 220 pounds, was recently auctioned for $4.03 million, almost spot on the price of gold as such. So no premium was paid for the fact that it was in the size of the world's largest gold coin. Now, to give you an idea of the weight of gold, how big a 200-pound coin would be, something about this size would be about 60 pounds. A couple of thick paperbacks put together. Maybe a little bigger than that. It would be about 60 pounds. And that gold coin was quite large, a foot and a half across, maybe 2 feet across. Gold does not rust or decay, and a relatively large amount of value can be stored in a relatively small space. This means the cost of holding gold are very low. Finally, the value of gold is less dependent on economic and political conditions than any other tangible asset, and far less so than our stocks, bonds, and other paper investments. True, but there is the danger in our modern societies, well, there's been the danger throughout all societies in history, that the government at any time can illegalize holding of gold. And it was made a felony in the 1930s just to possess it. You can have it in the form of collector's coins and jewelry, but bullion was illegal. That's dependent on economic and political conditions, namely political conditions, really. Now we skip to the next page. The reason to hold gold directly is not to make money, but to have some money in any and all circumstances. Okay, there's an interesting point. You don't put gold in your portfolio because you want to get rich. Although, if you catch it on a historic low and buy in, and then it gets to a historic high, within a decade or something, you might have made out pretty well. Right now it's selling at around 1,000 an ounce, I think, or 900 or 800. It was up to 1,100 an ounce or something. And in the 90s it was as low as 300 an ounce, or 280 or something. And if you would have dumped $1 million in back then, 10 years later have 3 million, not bad. And some people saw that far ahead. But as a general rule, gold holds its value. It does not swing wildly. And so it's not really an investment so much as a mainstay or a rock, something to prevent large swings in your portfolio. It stabilizes your portfolio rather than accelerating your portfolio upward in value. So now we're going to read virtually all of a section titled Gold and Investment, about 6-7 paragraphs, and then that's the end of what we're going to take from this lovely little flyer. The price of gold tends to fluctuate very differently from the price of other financial assets. The rate of returns on gold has a very low correlation to the returns on stocks and bonds. Because of this, gold can potentially reduce the overall volatility in a diversified investment portfolio without significantly reducing the portfolio's overall rate of return. Between 1968 and December 2003, the price of gold went from $35 an ounce to more than $400 an ounce for an annualized return of 7.1%. It happens that during the same period, Treasury bills provided exactly the same 7.1% return. Gold was far riskier, however. The standard deviation of the annual returns, a measure of volatility, for the bullion price was nearly 8 times that of Treasury bills. Okay, what's going on here? With the same return as Treasury bills, but vastly larger volatility, gold would seem to be an unattractive addition to an investment portfolio. Now, hold on to your seat. If you know very much economic jargon, then the next 30 seconds will be fine. If you don't, you might want to grab a cigarette or some cup of coffee. However, we recently examined the results of a hypothetical passively managed portfolio composed of large cap stocks, large cap value stocks, and small cap value stocks in equal amounts, rebalanced annually for the 36 years from '68 to 2003. We considered 2 additional portfolios, one with the same mix of equities but with 10% gold bullion, and another with 10% in 6 months Treasury bills. The addition of 10% gold reduced the total portfolio return by 0.07%, but reduced the standard deviation by 2.31 percentage points. The addition of 10% Treasury bills reduced the total return by 0.49 compared to 0.07, so that's 7 times more return loss, 7 times amount less return than gold by using Treasury bills, but reduced the standard deviation by only 1.82 percentage points. Okay, there's the economic jargon. Everybody, I hope you're back from getting your coffee or whatever. Thus, even though gold in absolute terms is far more volatile than Treasury bills, it has the potential to reduce the magnitude of the swings in the value of an investment portfolio. In the final analysis, gold is a viable form of portfolio insurance with a long track record. For most investors, devoting a small portion of a portfolio to gold-related assets is prudent. The best way to hold gold for investment purposes is to buy quality gold mining stocks and or the recently introduced gold-based exchange-traded funds, ETFs. Pretty recently introduced, I guess. This was 2005. So, there we have it. Gold is a good way to reduce the overall volatility of your portfolio. Treasury bills do that as well, but gold does it with less of a debit to your return. You still get as much of your return almost as without the gold, compared to Treasury bills, which are less volatile but also chew into your returns. The main point, though, about gold is not it is investment, it'll make you rich, it'll increase in value, none of that. The main point about gold is it's going to be valuable no matter what happens. So, if there's going to be economic turmoil, or if the government's going to collapse, or something like that, I guess that could be defined as economic turmoil, then gold is a way to not be affected by those vagaries. Some thoughts for the piggy bank.